Welcome to our part two, the update on rent regulation reform, how the market is proceeding, and that kind of thing. We've put a great panel together for you today. Firstly, we're going to give a general overview of the investment sales market in New York, see how we've been progressing. And Karen Blank, who is an economist, is going to talk about the impact of policy and regulation on our market. Douglas Eisenberg, and the Dean of Landlord-Tenant Attorneys, Sherwin Belkin. So great panel, and let's get right into it and talk about, I think one of the most interesting things is where are we in the market cycle? I think it's very clear that the peak of the market in this cycle was in 2014 and 2015. We had more buildings sell than ever before, higher dollar volume than ever before in those years. Since those years, we've been in correction mode, which is hard to imagine. If you simply looked at economic metrics and the broader economy, you would think that the commercial real estate investment sales market in New York would be booming. So let's look at jobs, for instance. Number one influencer on underlying fundamentals in commercial real estate are jobs. And I think that we started to see the correction in investment sales kick in October of 2015. It was very clear the market changed seemingly overnight at that point. But let's look at how the broader economy in the U.S. and the economy in New York City have changed since October of 2015. So our number of jobs in the U.S. over that period of time has gone up by 940,000 jobs. That's a 6.5% increase. In New York City, jobs have increased by 320,000. That's a 7.4% increase. If we look at the unemployment rate, in October of 2015, it was 5%. It's currently 3.6%. If we look at gross domestic product, nationally, we were at $17.5 trillion. We're now at $19.1 trillion. That's a 9.5% increase. In New York City, and the most recent data we have is from the fourth quarter of 2017, but it went from 1.6 trillion to 1.7 trillion, a 6.2% increase in local GDP. Consumer confidence and consumer spending are up. The stock market has rallied unbelievably. The S&P 500 over that period of time up 62%. The NASDAQ up 84%. Dow Jones Industrial Average up 71%. Interest rates have been cooperating. The 10-year was 2.05% in October of 2015. This morning it will open at 173. The Small Business Optimism Index has been as high as it's ever been. So if you just looked at these economic metrics, you would say the investment sales market in New York must be just going great. Why has it decoupled? Why has the investment sales market been now 50 months into a correcting market? Well, we don't really have a great explanation for that. It could be that fundamentals during the period from 2010 to 2017 just really got, or to 2016, really just accelerated so rapidly. Maybe they accelerated too rapidly. Maybe there was too much new construction and supply added to things. But the market has decoupled, and this is not the first time this has happened. There are times when our local New York City investment sales market is highly correlated to the broader economy. We saw that during the S&L crisis in the early 90s. We saw it during the Great Recession from 2007 to 2010. But the recession that we had in the early 2000s did not impact the local commercial real estate market at all. Values went up every year from 1993 to 2007, a 14-year period. So there was a decoupling of the local investment sales market from the economy in the early 2000s, but clearly we've had a decoupling here. So if we look at the numbers in the market, if we look at how volume has trended, and this is for Manhattan properties selling for $10 million or more, you will see that the peak of the market clearly was 2015. We had a little bit of a head fake there in 2018 where it seemed like dollar volume was headed up. The average correction in investment sales is about 3.5 years. We were around that point when we were having this seeming rally in 2018. And we didn't see that same increase in the number of properties sold, just in dollar volume. But that was to be expected, because when those two metrics shift, the dollar volume always leads the number of properties sold. So this was playing out like, oh boy, we're going into 2019. This is going to be a change in the market. Things are going to get so much better. And it just didn't happen. There are a number of reasons why. But if you look at where we are this year, we're on pace for about $18.7 billion in sales volume. That's going to be down about 34% from where we were last year and down 67% from the peak of the market. The other volume driver is number of properties sold. As you can see, we peaked again 2015. This year, we're on pace to be down about 36% from last year and 69% from the peak of the market. So clearly, this correction has been sustained. It's the longest correction that we've had. But unlike other corrections that we've seen, the diminution in value has not been nearly as significant as it has been during other corrections. During the S&L crisis, average property values in New York City dropped by 58% on a price per square foot basis from peak to trough. During the Great Recession, it was a 38% drop. Here, we're looking at maybe high single digits. And of course, it depends on location and product type, but generally, this has been a relatively mild correction in terms of value, but a pretty significant correction in terms of volume. So if we look at the not-so-bright spots in the market, and I promise I'm going to talk about some bright spots in the market because there are some, but the spots that are not so bright, we've clearly had some political headwinds. Policy changes have impacted the market. If you look, residential rent regulation reform, which is our topic for today, has caused some disruption in the multifamily housing market. Commercial rent regulation is now being proposed. Tax policy. Tax policy has negatively impacted the market in a couple of ways. One, the marginalization of state and local tax deductions has impacted the residential market, and real estate tax policy has been incredible. For those of you that own property, you've seen your tax bills consistently going up, and over the last 4 or 5 years, they've gone up very, very significantly. You know, the politicians are talking about doing something about all the vacant retail stores in town and thinking that maybe penalizing owners for keeping stores vacant is a good idea. Well, a lot of the reason why so many stores are vacant is because it's tougher and tougher for retailers to make it. Minimum wage has gone up very significantly, and while there are some benefits to that, the downside is that it makes profitability more challenging for a lot of retailers. And if you look at how real estate taxes have gone up, often in retail leases, there is a real estate tax pass-through. And if real estate taxes are going up so significantly, it becomes harder and harder for retailers to make it. So that's part of the reason why there are a lot of vacant stores today, is because real estate taxes have gotten so high, it's made it more and more difficult for retailers to be profitable. If tenant demand is something that is a concern, see a few tenants looking to move out of the city. That's not been a positive thing for the marketplace, and quality of life issues are something that has been challenging. Clearly, there are an increasing number of folks that are less comfortable with the way conditions are in the city today, but that's something that ebbs and flows. Enough of the non-bright spots. Let's get to the bright spots, because, it was funny. I was giving a speech a couple of weeks ago out in Long Island to the Appraisal Institute and the Mortgage Bankers Association. And halfway through the speech, I was like, Bob, you got to snap out of this. It's been so negative for so long. Let's find some good things to talk about. So shortly thereafter, I was supposed to give the keynote speech at the Asian Real Estate Association of America. And they called me up and said, Bob, what's the title of your speech going to be? And I said, it's going to be Bright Spots in the Investment Sales Market. Not knowing what they were at the time, but I was challenging myself to find some bright spots to talk about, because I don't want to be depressed. I don't want to depress the crowd. And there are some bright spots. Number one, land market activity. Right? We sell a tremendous number of development sites, and for several years, that market has been very, very challenged. we've seen over the past 2 or 3 months more activity on development than we've seen in years. And some of that has to do with the fact that values have been reset. Values are lower now. But the number of folks that are looking to build new buildings in the city is significant, and that demand is across the board. It's not only residential sites, but it's hotel sites, office building sites, and that has been very, very tangible and very good to see, because land activity is indicative of the way developers perceive market conditions will be 3 or 4 years from today. So there is some underlying optimism out there, and it's manifesting itself in really good activity on land. Second, Class B, C, and D office buildings, particularly value-added office buildings. The activity in that market has been really significant. And typically, when we put a property out for sale, if we get 100, 120 confidentiality agreements signed, we think that activity is really, really robust on that property. We have an office building on 22nd Street now that we're selling, 242 confidentiality agreements signed. And interestingly, a number of those buyers are buyers who historically have only bought multifamily properties, but they're looking to get into other asset classes now. So because of the strength of the office leasing market, the Class B, C, and D office buildings are also seeing very robust activity. Foreign capital flows. Everybody thinks that foreign capital has evaporated from the market. And part of that negative perception is that in 2015 and 2016, the foreign capital flows were so excessive that we got used to this market in which every large transaction was being done by a foreign institution. But if you look at the pace that the market is on today, we're on pace for about $5.6 billion of foreign capital invested into the market. That's only slightly below the long-term average over the last 10 years of foreign capital being deployed into the New York City marketplace. And that's if we take out those 2 boom years of 2015 and 16. So foreign capital flows are very encouraging. The industrial market is on fire. There's not a lot of industrial in New York City, but there is quite a bit, and there's going to be a lot more. Demand for space is tremendous. Vacancy rates average about 3%. In the Bronx, the industrial vacancy rate is 1.5%. That market is doing really, really great. And the last thing I could say to be positive is that the market has been, is, and always will be cyclical. So it's down now in terms of volume, but that will come back. History has shown that these cycles are consistent, and so it's just a matter of time before things get more positive. So those are some bright spots to look at. But we're here today to talk about the multifamily market, rent regulation, how that's impacting things. So let's look at the multifamily sector. Not unlike the broader marketplace, you see that the volume of sales in terms of dollar volume is down very significantly from last year and the peak of the market. Number of transactions, same thing. So this is not unusual. What was unusual, when I looked at the stats, I saw that the average multifamily sale in Manhattan, above $10 million, averaged $891 per square foot, up from last year. And at the same time, the average cap rate rose to its highest level since 2008. So I went to our research people, and our research group at JLL is absolutely fantastic. I said to them, I said, guys, you're always so accurate with all your data, but there's some mistake here. Can't be. Econ 101 teaches us that if cap rates are going up, value has to be going down. So let's take a deeper dive on this. Take a look at all the metrics. Take a look at the statistical sample. Is this counterintuitive movement in these two variables? Was that there because the statistical sample of sales was so small? Was it there because the basket of properties sold was different? We have to look at every single transaction to try to understand this dynamic. And what we discovered was that if you look at average net operating income per square foot, in 2018 it was $26 a foot, and so far this year it's been $39 a square foot. So that tells you that the composition of the properties being sold is a very different composition than we've seen in the past. So it explains why we have that difference. Clearly, there's upward pressure on capitalization rates, and that is mainly because of the rent regulation reform has made it more difficult to extract upside from properties. So it's certainly a market changer, and so we're going to talk about what these changes have been.